it can still make sense to have, individual be an owner or at least be the insured on their own policy to tap
Yeah.
into, the death benefit if something were to happen. It can be a benefit, but then that way to get essentially the long-term care benefit on both spouses as well.
Welcome to the Next Level Income Show, where it's our goal to take your income, your investments, and your life to the next level. I'm your host, Chris Larson. If you haven't yet, get a copy of our book for free at our website, nextlevelincome.com. That's www.nextlevelincome.com. Just click on the book link, and I'll even send you a copy if you put your address in. On today's show, we have Blake Brogan and Ron Zabriskie. Blake is a wealth strategist whose role primarily involves interacting with current and prospective clients of Money Insights. He has been in the financial services industry for 8 years, primarily working with maximum overfunded life insurance strategies. Blake graduated from Grove City College with a bachelor's in entrepreneurship, and he resides in Michigan with his wife and 3 children, and his free time enjoys playing golf and Michigan State athletics. Rod is the president of Money Insights, working directly with clients and the team to create an enjoyable environment for all. He has worked in financial services since 2009, after a decade of working in small businesses for others. He holds an MBA with an emphasis in entrepreneurship, as well as an undergraduate degree in marketing communications. Rod's married to his wife, Jody, and they have 7 amazing children. And today, both Rod, Blake, as well as myself, are going to be talking about the various strategies that we personally employ with Money Insights, as well as answering some questions that a lot of listeners have had about long-term care insurance and how it can blend in with the strategies that we are using today. Blake and Rod, welcome back to the show.
Thanks, Chris. Glad to be here.
Yeah, great to have you here. So we're going to be tackling a topic that I've been getting a lot lately, which is long-term care. And it can be very confusing because it's complex, and there's a lot of different pieces and parts to this. And as the 3 of us were discussing this topic, I thought it would be good to do an overview first of the strategy that I have at the core of my financial plan, which is cash value life insurance. Blake, I know you work with a lot of our clients on our investment optimizer approach. And you guys have both been on the podcast before, but if you guys don't mind, just give a quick overview. And Blake, if you want to go first, just a little bit about your background and what you guys do at Money Insights, that'd be great.
Yeah, sure. So, at Money Insights, we do a couple of things. We help educate people on various types of alternative investments, a lot of the things that Next Level Income is doing. And then one of the strategies that we'll plug into that, we call the investment optimizer, which is using, as you mentioned, high cash value life insurance, basically as a replacement of your opportunity fund for those type of investments. So you're not replacing the investing that you would do. You're just basically optimizing how money flows in and out of your account. So, very briefly, I know you have webinar on your website that people can go watch more details, but very briefly, if you're saving up for, let's say, a real estate syndication or a car wash, and you have to put a large lump sum into those, typically before people are using that strategy, they're just building up money in a bank account because it's safe, it's liquid, but it's just not doing a whole lot for you in between those deals, right? You're not earning much. There's no tax advantages. So that's where we're using the investment optimizer strategy, using a high cash value life insurance policy to store your money before you go and invest in those things. So you're going to get the same safety and liquidity, but a higher rate of return. And then a death benefit comes along with it. And then there's some other benefits that we'll jump into here in this podcast. And then the ability to leverage that into it and into the investments, have your money working for you in a couple places at the same time. It's just a better way to flow your money in and out of deals.
Yeah. And, Rod, I started working with you and Christian at Money Insights, and this was before Blake came on board on the team a few years ago. And the reason is, I've told the story a couple times on the podcast and previous episodes, is that my wife and I started our policies before my first son, Ethan, was born. He's 14 now. So, we're talking about 15 years ago. And I was looking for options for 529 plans. I was like, well, I don't know if I love 529 plans. I'm not a huge fan of qualified plans for multiple reasons. But, for example, it's like, let's say you have a kid that, grows up and like my friend's son wants to do an HVAC apprenticeship and have his own HVAC business, or, electrician or that sort of thing. Well, maybe he's not going to use his 529 plan, but that money could be used to start a business if it was in, for instance, a life insurance policy. The other thing I'm not a huge fan of in the qualified plans is that you have limited investment options. And, when you have great cash flow options, like, we do here in the real estate space. It's nice to have access to those. But I started these policies with the very simple idea of just having a guaranteed amount of money for my son for college. And then I realized that I could use the cash value for other options, for building spec houses like my wife and I did, and then investing in syndications and even starting your own syndications as my partner I did in 2016. And, as I started doing this, I had a call, about 8 years ago with my agent, and he said, "Man, Chris, I wish everybody was doing this."
Hmm.
And I said, "Wow, why didn't he tell me about this? Why'd I have to learn on my own?" And that search led me to Money Insights with Christian and you, Rod. So, what Blake talked about, if you want to learn more about the investment optimizer approach specifically, check out the banking link on our website. Also, Rod, you wrote a terrific book, which I wrote a little intro, a little forward to.
Yeah.
If you want a copy of that book, which details this strategy as well, send an email to info@nextlevelincome.com, info@nextlevelincome.com, and just say, please send me a copy of the Money Insights book with your address, and we'll get you a copy sent out. But Rod, you mind sharing a little bit about what listeners will learn if they get a copy of that book in there, and really, why you and Christian, started Money Insights, and why you do things the way you do.
Yeah, I'll start with myself personally. So
Yeah,
my start to the journey began, I was in college and I read Dad Poor Dad by Robert
yeah,
Kiyosaki. And that just changed my whole mindset, moving forward in life. And the reason is because like my family was entrepreneurial. We were very much the go to school, get a good job, create this kind of security
yeah,
on someone else, right? And then I got my eyes open to, hey, if you're a business owner, you can do things completely different. And from a
yeah,
tax standpoint,
yeah,
controlling your own destiny standpoint.
yeah,
And then when you invest in alternative assets, real estate, your own and other people's businesses, all these different things, it's just a completely different way of living life, right?
yeah, yeah,
Than what the traditional side would teach. Like just put money in your 401k and do all that kind of thing. So
yeah,
I was on that path. I wanted to be a business owner. I met up with Christian in 2010, and initially we weren't setting out to start a business, but we were just setting out to help people be more smart financially in their
yeah,
lives, right? From a life insurance standpoint, and I'm kind of preaching the choir here, but
yeah,
a lot of people hear that and they're like, financials, stability and wealth building and all this kind of stuff with life insurance. What's that all about?
yeah,
But I think what it did for us is it allowed us to understand the nuts and bolts of the life insurance side, how to build it
yeah,
correctly and do it right, so that by the time we then started working with people like yourself who maybe already are in the alternative space, or we meet up with a lot of people who are wanting to get into the alternative investing space, and then we just teach these kind of, I don't know, tips and tricks, kind of thing to make it better. Like make
yeah,
do the same investing, like Blake said, do the exact same thing you're doing and do. We're just going to make it better by the way that we, optimize it through
yeah.
the investment optimizer.
Yeah, no, I love that, and that's one of the reasons I like working with you and Christian and Blake at Money Insights is that first off, you guys didn't try to pitch me on something when I first spoke to you. You guys said, "Hey, this is what you have. This is what you can do to really optimize the policies that you already have," and that
Hmm.
that impressed me because all the other groups I talked to tried to basically sell me or resell me or move my policies over, and I really appreciated that, and I incorporated really all these lessons in chapter 3, Blake, as you mentioned in my book, which you can also get at the website. So we got a couple books here for you today. But yeah, what I use for our opportunity fund, and the opportunity fund would be classified as basically where do you put your money in between deals. And Rod, what you said, and Blake, what we put together in the webinar at the banking link or nextlevelincome.com/banking is the investment optimizer, which is really taking your investment strategy that you're already doing in cash flowing assets and marrying it to one of these specifically structured life insurance contracts. And what I love about it is we've done this for a lot of clients now, Blake, is that this strategy essentially pays for itself. So, we talk about in that webinar how you actually get higher rates of return And one of the things is, and this is the thing that I really don't like when I have this conversation with individuals that say, "Oh, this is not a great investment option." It's not like we're not saying, "Hey, this is an investment option." This is as you kind of talked about, Rod, this is a system of how to flow your money through this. So you have the protection of life insurance, how you have the enhanced benefits from your return perspective, but you also have, some of these guarantees that you get with life insurance. And one of the things is whenever I have a conversation with someone that says it doesn't make sense, I say, well, what happens if you die? Like my father did when I was 5 years old. What happens if your kid doesn't go to college, right? And you can't use that 529 plan. What happens if you exceed the limits on the estate tax? And oh, well, that's different. Well, that's what we're trying to teach. We're trying to teach people how to be rich and truly live, these lives and do that. And one of those things is long-term care. Now, Blake, I know we've talked about this, but like the policies that we set up for my wife and I, so maybe we'll talk about kind of three different examples about like, hey, does long-term care make sense? Kind of a younger individual, maybe like somebody in their middle age, and then somebody that's older. Like, you mind sharing kind of one of the provisions that, like I know my policies have them, this long-term care rider provision, and how that works as part of a policy. Because my bet is a lot of listeners that
Mhm.
have these policies, they have this and they don't even realize it.
Yeah. And it's something that we try to hit on,
Yeah.
as people are setting these up, that you have
Yeah.
this additional benefit. So, you know, we are using with the investment optimizer, we're using whole life insurance, which has a permanent death benefit. But
Yeah.
because, and maybe we can get into more of some of the
Yeah.
struggles that the long-term care industry has had.
Yeah.
Um, but because we have this permanent death benefit, an insurance company, as soon as we put that policy in force, they are on the hook to pay that death benefit. So it's worked out that you can put these riders on the policy, which we put on for every one of our clients, and it's a free rider. But specifically, what you're talking about here is what we would call a accelerated death benefit for chronic illness. There's also one for a terminal illness as well.
So let's pause real quick. So you just said something I think is very important. So let's say I go to my homeowner insurer, State Farm, and I say, hey, I want to add a rider for, um, I don't know, like maybe I bought my wife a piece of jewelry for our anniversary. I say, hey, I want to add a rider for this. They're going to say, okay, here's how much it's going to cost. What you just said was that this is a free rider that everybody that sets these policies up gets.
Yeah, that's correct. And
Yeah.
you know, one of the issues, I'll just touch on it here, with long-term care insurance,
Yeah.
like, traditional, not involve life insurance at all, is that you're paying premiums for often a really long time. If yeah, I could set it up on
Yeah.
someone, my age and in their 30s now, but depending on what age you are, you're going to be paying into this policy for a really long time. And I think about 50% of those never actually pay a benefit, right? So you could be paying for it for years. And even in certain situations, the premiums could increase as people are getting older. So there's kind of some horror stories out there just because it's a tough market.
And these are
So you
specifically long-term care policies.
exactly. Yep.
Yeah.
Yep.
Yeah.
So long-term care policies, and that's why some people have, wanted to stay away from them. Yes, they want the
Hmm.
protection, but it's just it's a tough product.
Yeah.
Because of that permanent death benefit that we have on these policies, essentially what the insurance companies have said is you can put these riders on and we'll attach it for free. So, again, we're setting these up primarily to build cash value and invest and things like that. Yes, there's
Hmm.
a death benefit that's coming along with it, but there's also this chronic illness rider that's coming along. So basically these riders say is that if you lose two of the six functions of daily living, then
Hmm.
you'll qualify to accelerate the death benefit. So basically, they'll pay you a portion of your death benefit before you've passed away. And it's a good deal for the life insurance company because they're going to owe you this money eventually, so they can pay
I
you
gotcha. So that's why
a
they do it
por
for free. Yeah.
exactly.
Yeah.
So there is a cost to it, but the cost is on the back end. So
Hmm.
and there's formulas for this. So depending upon your age and when you trigger it at 65, let's say you said I need $100,000, it might cost you $350,000 of death benefit to do that. So 350,000 that your family would have gotten on your death, they're going to give you 100,000 now.
I
If you're
gotcha.
85 years old, it might be they'll give you 100,000 now and it costs you 150,000 of your death benefit. So the
Gotcha.
benefit though
Because
is
of the
that we
time
get
value of money effectively. Right.
Exactly.
Yeah.
Yep. Life expectancy is a
Yeah.
certain age, and then,
Yeah.
based upon what age you need these funds, they're going to give it to you. So the
Yeah.
benefit is that we don't actually really pay for it until the back end and when we use it. So it's
Gotcha.
it's just a benefit that we get for free
Yeah.
when we set these policies up.
Yeah. So for example, like let's say you have a $2 million policy, Blake. What you're saying is if you can't perform two of those activities of daily living, you would qualify to start drawing that death benefit before that. And it may be really close to dollar for dollar, or if you're earlier on in your life, it may be less than that.
Yeah,
Yeah. Yeah.
but it's a great option to have. I mean, you might have
Yeah.
other, as if you're building up your
Yeah.
passive investing, you could have things like that.
Yeah.
Having a big liquid bucket that you can
Yeah.
tap into for a lump sum can
Right.
be massive at that time of life.
Yeah. Yeah, so I was just talking to a friend of mine. He's a financial planner yesterday at my son's lacrosse practice, and he was giving the example of a couple. They're older, they're retired, and the husband is going to be going into an assisted living facility. Their current expenses are, around $100,000 a year, so eight to $9,000 a month, and it's going to cost them $5,000. So, if they have one of these policies, which I can tell you they don't, unfortunately, but they could draw on that for his $5,000 per month in this scenario. And I got to say, they should have the same rule for our politicians, right? If you can't perform two activities of daily living, then you have to retire, right? That would
Oof.
be a good.
Oof.
We should have that rider. Can we do that? I'm just messing around. Hopefully people appreciate that that's a joke, but maybe it shouldn't be. So Rod, again, I think this is, if you are looking into these policies, if certainly make sure if you have a policy that if this is an option, you take advantage of it. Kind of with this being said, Rod, you've been doing this a long time. I'm just going to ask, just the question: does long-term care insurance even make sense anymore for people?
Yeah, it's a great question. And the challenge is you ask that question from the consumer side,
Yeah,
and the insurance companies are asking themselves that question from their side because they've had a really difficult time pricing it correctly, playing it out correctly.
yeah,
Because, like Blake said, if someone buys it when they're and maybe your friend, if you're in your 40s or 50s when you buy it, chances are it's going to be decades before you need it. Well,
yeah,
price of healthcare has gone up dramatically over the last
right,
10, 20, 30
yeah,
years, right?
yeah,
So if you're committing to pay that bill, how do you price the
right,
premiums correctly so that it makes
right,
it palatable for people to buy it
yeah,
and allows you to have the resources you need when it comes time to start paying these bills out for people?
yeah,
So now on the consumer side, it's a challenge, right? You look at the and you say, "Oh, great. Do I want to pay whatever $300 a month as a 40-year-old, $500 a month as a 40-year-old, 50-year-old?" And it just getting higher and higher as you get
mhm,
older. And so you could say, well, when I was 55, it was a good idea to get into it, but now I'm 75 and they keep increasing the premiums. I haven't used it yet.
right,
I'm getting closer to the time where I'm more likely to use it, but they're
yeah,
increasing the prices. I mean, what do I do?
yeah,
So there's just some really inherent challenges with it. And then, like Blake said, roughly 50% of people who have the insurance don't ever end up using it. And in that sense, it's like any other type of insurance, right? We buy auto insurance, hoping we don't ever use it, but for
right,
just in case, right? Health
yeah,
insurance the same way, homeowners insurance. So
sure,
in that way, it fits in that same category. But man, can you imagine paying hundreds of thousands of dollars over, 3 or 4 decades and then just not
yeah.
ever needing it or using it? So it just
Yeah.
creates some inherent challenges.
Yeah, whereas I mean, I just kind of going back to what Blake was talking about. I mean, if you put that same $500 to work into a life insurance policy,
Yeah.
that those, like you said, hundreds of thousands of dollars are going to be accessible in multiple different ways for
Yeah.
you, and you can actually use it to through the investment optimizer approach. Which, just as a reminder, this is I pulled out a copy of the book here. This is a copy of the book you can get. Again, just shoot us an email at info@nextlevelinCome.com, info@nextlevelinCome.com. Say, please send me a copy of the Money Insights book with your address, and we'll send you a copy, and it walks through that strategy, or you can check out the webinar at the banking link. So yeah, it's one of those things, Rod, where a lot of people say, oh, it just doesn't make sense. There's too many variables out there.
Hmm.
Um, what do I do, in this scenario?
Yeah.
What, I guess, at what point is it too late to take advantage of this, and from a life insurance perspective,
Sure.
I guess first from a long-term care perspective. So let's say you're in your 60s and you're like, hey, I want to protect my family from this, because if you're a listener, if you're listening today and you don't know, the way it works today is if you want to qualify for Medicaid, so if you want the government to pay for your long-term care, you basically have to spend down nearly 100% of your assets. What's it
Right.
down to, $35,000? Is that
I
right?
think it's 2,000
Is it
for
2,000?
Medicaid.
I know
Yeah,
it's
for
low. I know
Medicaid,
it's
I think
low.
it's
I forget.
really, really
I
small.
Yeah, it's you
Aside
basically have
from
to
a home, like you can keep your home, you can have a car, right? So there are
yeah,
assets like that that they don't
yeah,
count against it. But man,
yeah,
in terms of like liquid assets, retirement
yeah.
assets, all that kind of stuff, it's really low.
Yeah, so basically the point is you're paying for long-term care unless you've basically spent all your liquid assets or given them away.
Yeah.
Which, that may be an option for some people, but chances are if you're worth several million dollars, you don't want to blow through all that but before doing it. So I guess the first question, Rod, is, at what point is it just like this long-term care doesn't make sense, like almost definitively? Is there any certain scenarios where it just does not make
Yeah.
sense? Are you a high-income business owner or professional earning 200,000, 300,000, or even more a year, but still feel like you're living paycheck to paycheck? Are you comfortable working until you're 65 or 70 to retire, or do you want to achieve financial independence and live life on your own terms? You could join myself and Matt Four and learn how we both became financially independent in our early 30s. We will teach you how to make, keep, and grow your money, teaching you strategies to maximize your earnings, keep your income that you've earned through tax strategy and legal structures, and ultimately teach you how to grow it by determining your personal investing strategy, as well as teach you how to analyze investments so you can grow your passive income to the point to live life on your own terms. Our coaching clients reliably do this in 7 years or less. To learn more, check out our coaching program at nextlevelincome.com/coaching. That's nextlevelincome.com/coaching.
Good question. I mean, if you can no longer qualify for it, because as with
Yeah,
other types of this kind of insurance, life insurance, disability insurance, they're going to underwrite you,
right.
right? So they don't want to be just taking people on who are ready to use it, right?
Yeah,
Wouldn't work economically.
right.
So they're going to underwrite you. You still have to be healthy enough to qualify for it,
Yeah,
right? But I guess not necessarily an age issue as much as it is, are you healthy when you're looking for it?
gotcha.
But if you get to a point where whatever, you heart attack, or you have some sort of chronic thing that you're dealing with, well, they just may not take you on, or even if they do,
Right.
the premiums are just going to be enormous, right?
That makes
So
sense. Yeah.
that's kind of the
Yeah.
practical part of it.
Gotcha. Yeah. So I mean, at some point when you're like in your 90s, 80, like 80s, it's probably not going to make financial sense, right? Because
And
it's like, as we were talking about, like, it's a time value of money. It's what I love about life insurance is it's actuarial. It's just numbers. It's just the
Mhm.
law of large numbers. So, the life insurance company just looks and says, what are your chances based on your age of this occurring? And then based on your health, et cetera, and doing those things. And what about, Rod, from a life insurance perspective, like where does it not make sense to, I guess, um, assuming you use the rider, like, is it the same thing, like, based on your qualifications? But from a
yeah,
financial perspective, is there an age that doesn't make sense?
yeah, I think it's the same thing, being able to
Yeah,
qualify for it. So we have clients
yeah,
who are obviously getting life insurance policies in their 20s and 30s,
yeah,
and their primary goal is not long-term care. Their
right,
primary goal is what we talked about earlier, investment optimizer,
yeah,
and or cash or tax-free income in
yeah,
retirement, and or death benefit protection for their family, and or estate planning, right? There are a lot of different reasons why someone may get that policy, and it's just going to carry forward.
yeah,
So then you say, okay, well, what about people in their 50s or 60s, or even 70s? And again, as long as they can still qualify for a life insurance policy and it makes sense
yeah,
to do that, probably in other contexts. If you're only getting the life insurance policy for the long-term care,
yeah,
it's probably not going to make a lot of sense. Like
yeah,
the premiums you're going to in there. And again, the only reason you would do that is if you said, I want someone to get a benefit, right?
yeah, yep,
Even if I don't use this while I'm living, but
yeah,
someone's going to get a death benefit,
yeah,
and that's part of the thinking, then great.
yeah,
Makes sense, right?
yeah.
Now,
That's a great point.
when let's say someone gets to a point where they either age out, because again, once you get into your 70s, it's more difficult to create a life insurance policy that's efficient
Right.
in providing that.
Yeah,
Uh, or you kind of can no longer qualify just from a medical standpoint.
Yeah.
There are other options. They call asset based or annuity based long-term care.
Yeah.
And essentially what you're doing then is you're taking a lump sum. Let's just say you take whatever $100,000 that you have sitting in a qualified account somewhere, and you move that into one of these hybrid annuity uh, contracts that also covers long-term care. The kind of benefit you can get is still more, it's more beneficial if you can qualify from an underwriting point. But even if not, if you're not on your deathbed, right, basically, then you can
Yeah.
qualify for some level of long-term care benefits
Yeah.
so that really people of any age can look at it. It's worth considering and looking at it to
Yeah.
see, hey, does it make sense to do this? And in that case, you're not paying an ongoing premium. You're just dropping a lump sum into this annuity
Yeah.
from the standpoint of the growth of the underlying value of the annuity or whatnot. They're not great. Like you might have like a 1% a year growth rate or something on the cash
Yeah.
value or on the annuity account. But the point is that there are added benefits for long-term care, same kind of
Right.
thing. You no longer can do any two of the six activities of daily living and or cognitive impairment, and then the benefit kicks in. And one thing that I think is important to point out on this long-term, one of the other challenges that they have is that they're defining what the benefit is. In other words, how much
Mhm.
monthly stipend do you get if
Right.
when you qualify? And then secondly, how long does that last?
Right.
Right.
Yeah.
So again, if I'm making a decision today and I'm 49, right? So I'm not like need it likely for another 30 to 40 years.
Yeah.
Well, who knows what the costs are going to be when that time comes?
Right.
And so again, that's the beauty of the life insurance, because if I'm accelerating a portion of the death benefit, they're not turning around and saying, "Hey, here's the most you can get as a monthly stipend." They're just
Right.
saying, "Here's the total value that you have access to. You get to decide how you use it."
And
Right?
that's yeah, and that's what I love. Like there's, the flexibility that these policies have, and they're private contracts, right?
Correct.
But just to underscore one thing you mentioned, Rod, I think, I've had this conversation. We'll kind of give a couple examples here. I had a conversation with a young gentleman. He's about 35. He's like, I love this strategy. I want to do it. And, I said, well, hey, like you know, do you have a family? You married? Basically, what is your insurable interest? He goes, I'm not married. I don't have any kids. And I was like, okay. I was like, well, why do you want life insurance? He goes, well, I don't really necessarily want life insurance. I just want to use this strategy. And I said, well, you know, I said, look, I don't hate to not sell you on this idea, this concept, which I love, but I said, if you don't have a beneficiary for it, if you don't have a planned beneficiary, like, why do you really need to pay for it? So look, if you're listening and you're single and you're making a lot of money and you don't have a family or a cause that you want to contribute money to, maybe it doesn't make sense for you. But certainly when you have that insurable interest, I think that's the question that you should first ask yourself. And then Blake, we just finished up a couple policies on a couple, and they're both correct me if I'm wrong, but about 65. And so just from an age perspective, like the numbers worked well for them at 65. And they also were able to put these long-term care riders on their policies as well.
And I think that one thing to add there too is oftentimes we'll split up the amount that you want to do on both spouses, right?
Okay.
So it can
Yeah.
make sense to have, even if you're like, hey, the primary breadwinner, let's say,
Mhm.
and I don't really need insurance on my spouse for whatever reason, it can still make sense to have, individual be an owner or at least be the insured on their own policy to tap
Yeah.
into, the death benefit if something were to
Yeah.
happen, it can be a benefit, but then that way to get essentially the long-term care benefit on both spouses as well.
Gotcha. Yeah, so that's a great point. It's like, maybe you have a $2 million policy on the primary, breadwinner, as you mentioned, but maybe you're better off doing 1.5 and 500,000 or a million and a million from um a cost effectiveness perspective, but also from a benefit perspective and do that. So, I love that. I love that strategy for doing that. And that's exactly actually what that couple ended up
Mhm.
doing. And when you get into
Hey,
the
Chris.
higher, oh, sorry, go ahead, Ron.
Yeah, no, I,
Yeah.
I was just going to circle back because you
Yeah.
mentioned the person that they're not married, they don't have kids, things
Yeah.
like that.
Yeah.
But we actually do write a lot of policies on people like that. And again, it's not because, like your friend said, it's not because they're looking specifically for the insurance part of it now, but the investment optimizer part of it
Yeah.
valuable. But then
Yeah.
eventually, if they live out their dreams, whether they end up getting married or whatever or not, from an estate planning perspective, it's valuable. From this long-term care perspective, it's valuable.
Yeah.
From a tax-free income perspective, it can be valuable.
Yeah.
So I guess I would just say don't eliminate yourself just because
Yeah.
you don't currently have that, immediate income replacement type of need because my family's counting on me kind of thing. Because a lot of other reasons why someone would want to do it.
I appreciate you saying that because that is one of the things. I mean, these policies also act a lot like a private pension plan
Yes.
where you
Yep.
have, I mean, that's why it's one of the reasons it's the base of our financial pyramid is that, you get that immediate death benefit, but also you have a guaranteed return that converts into a guaranteed amount of income in the future. And I mean, we certainly don't say there's any guarantees in the real estate space or the
Right.
stock and bond world, but this is one of the rare instances in the financial universe where there are guarantees that are out there and doing that. So that's a great point, especially like let's say that gentleman did have plans to get married, did have plans to have a family, and said, hey, I want to do this while the rates still make a lot of sense.
Yeah.
There's still a lot of good reasons for somebody in that category to do it.
Yeah. And in
Yeah.
fact, we have a lot of people putting policies on their kids, right?
Yeah,
Even minor
absolutely. Yeah.
kids as
Yeah.
a like catalyst to, hey, number
Yeah.
one,
Yeah.
we're going to get you insurance while we know you can qualify for it.
Yeah.
But number two,
Yeah.
probably more importantly, is I want to teach you the culture, the twos of what I'm doing in terms of investing.
Yeah.
And one of the core pieces is the investment optimizer. And so
Yeah.
this has your name on it.
Yeah.
Initially, the adult is the owner, of course, but
Yeah.
eventually you end up passing that on to this child when they get to a point where you're like, yeah, they have this out, they're going to be
Yeah.
responsible with this money. Then you pass it on, and they just carry on. They basically pass the torch carried on.
Yeah. No, I love that. And hey, the last example I'd like to go through, you just kind of you mentioned catalyst. You kind of gave me a catalyst for a thought here. Blake, for somebody that, maybe they have a windfall coming up where they're growing their earnings, and they say, hey, I'd like to set up one of these policies. And, typically they work well, when you have, I don't know, what's like kind of a minimum amount to set up an investment optimizer strategy from an annualized perspective.
We'll set it up for whatever you want to set aside for investing,
Yeah.
but
Yeah.
typically that'd be a minimum would be $5,000 or $10,000 a
Yeah.
year on a
Yeah.
low end.
But for somebody that wants to lock in insurance, let's say they're in their 30s and they're like, hey, I'm growing my business. I'm thinking of a specific, couple that we've been talking to, that are growing a very successful business. They're looking at convertible term. So
Mhm.
they're taking out convertible term policies that they can ultimately convert into these permanent whole life policies, right?
Yeah. And I mean, I'll use myself as an example.
Yeah.
I've got little kids. I use the investment optimizer
Yeah.
strategy. I have multiple policies set up, but the way that we set them up, we're just going to design them for the least amount of death benefit possible based upon how much we want to
Yeah.
put in. So,
Yeah.
it's a different way of thinking about insurance because
Yeah.
we're more focused on the cash benefit. So
Yeah.
for that reason, I might only have I put it this way, I don't have a death benefit to cover my family if something were to happen to me, right? So I'm building up cash there. So what you can do is supplement this with what we call a convertible term policy. So convertible term is term insurance. So it's, you might get it for 10, 20, 30 years. You're paying a very low premium. You're not building any cash value, but you get a very high death benefit. So if
Yeah.
you're someone who's out there in your 20s, your 30s, or you're like, hey, I think my financial situation is going to change over the next 15, 20 years, it can make a lot of sense to lock in that insurability, get this convertible term policy in place while you're healthy now, because what that allows you to do is convert to an investment optimizer style policy or any other permanent life insurance policy that has these benefits that we're talking about without going through underwriting. So for myself, for example, let's say I get diagnosed with cancer next year. Well, I can still do this strategy because I have the insurance company on the hook to treat me like I'm a very healthy, guy in my 50s because I have this convertible term. Even if I'm on my deathbed, I can start converting these into permanent policies. So that can be a strategy that makes sense if you're young, or if you're like, I want to do strategy later, or even if you're doing the strategy now, but you want to do it at, bigger numbers down the road. Yeah. That's where convertible term fits in.
Yeah. And I love what you mentioned. You said, you can, like my wife and I started, with the 2 policies. We had another 2 policies. You had policies on your kids. You have convertible term. You can stack these policies, and so this approach is scalable from all different angles. So I think if you're listening and you're intrigued by any of the topics that we talked about, whether it's the investment optimizer approach, I think for starters, check out the webinar at nextlevelincome.com/banking, or click on the banking link. Get a copy of our book, as I mentioned, and feel free to send email it to info@nextlevelincome.com and just say, please send me a copy of the Money Insights book with your address. And then if you are interested in some of the long-term care options that we talked about, Rod, or just seeing how any of this and any of these strategies apply to your specific situation, you can set up a free strategy session with us and just email us or email me directly, chris@nextlevelincome.com, and we can get a strategy session to set up, talk through your specific circumstance, and see what may or may not make sense for you. Rod, always good to see you. Blake, always good to see you as well, my friend. Thank you both for taking the time and sharing your wisdom with our audience today.
Thanks, Chris.
Hey, Chris here again. I hope you found this episode valuable. Now, I have one more thing to gift you. We have a page for my coaching clients where you can get a free copy of my book, as well as much more from previous guests on the show. Just check out nextlevelincome.com/coaching to get a free copy of my book, audiobook, and much more. I'll send you a copy of my book and cover all the shipping costs as a thank you for listening to the podcast. Also, please like, share, and take just 90 seconds to give us a rating on Apple Podcasts.